Hello everyone, my name is Pat Somerville. I'm Senior Partner and Head of Business Development here at Hamilton ETFs. I'm joined by Rob Wessel, our Managing Partner, and also recognized as one of Canada's leading experts in the Canadian bank and financial space. So Hamilton ETFs, we are currently the number 2 provider of Canadian bank ETFs, which accounts for over $1 billion of our overall AUM, which is approaching $3 billion right now. Part of our ongoing commitment to our supporters is to provide timely and deep insights on the sector, which we think you will find helpful. So I'm here today with Rob. We've been talking a lot about rising political risk and regulatory risk for the Canadian banks. Last week, the leader of the Conservative Party called on the government to reject the RBC acquisition of HSBC. The leader of the NDP has also expressed his opposition. So we thought we'd bring you here to talk about this development and what you make of it.
Yeah, so it's interesting. There's a lot to unpack. I would say the first thing is the transaction is still very likely to be approved. So I think the arguments when the bank mergers in the late 90s were rejected, the policy arguments against mergers were quite strong. The arguments for mergers were quite strong, but also against. Here, the policy argument against approval is fairly weak. HSBC is only 2% of the Canadian market. It's not terribly large, so I don't know that it's going to really dislocate or have any meaningful impact on the competitive environment in Canada. Having said that, the probability it gets rejected is considerably higher than zero. I would say probably 80% chance it gets approved, maybe 20% chance that it does not get approved. So let's say for the sake of discussion, it does not get approved. We actually don't think that'll have a significant impact on RBC stock or even the share prices of the banks writ large, which are already, as we know, quite weak. The acquisition of HSBC is the second largest announced acquisition in Canadian bank history after Bank of the West, 6% accretive, but it doesn't seem like the market's really pricing in those accretions. So I don't really think that if it was rejected, it would have a meaningful impact on RBC stock. In fact, what is likely to happen, or what would be likely to happen, is the same thing that happened with TD as it relates to First Horizons, is they would announce a concurrent buyback. And given where stock prices are, a buyback of size with these share prices and multiples would probably be seen as fairly positive. On the other side, and on top of that, the capital ratios of RBC would remain extremely high, which I think the market would largely favor given the economic risk. So I think as it relates to this development last week, I don't know that the issue is as significant as it relates to RBC. The greater significance is that it's arguably that it's further evidence of rising political and regulatory risk, which is fairly new for Canadian bank investors.
Okay, so why don't we unpack a bit that right now and talk about that specific risk, political risk, and how that applies to the whole sector and what this all really means.
Yeah, so one thing that, for those of us who follow the global banks, we have talked about in the past that one thing that has really stood out for Canadian bank investors is that political risk and regulatory risk were quite a bit lower here in Canada than they were in other jurisdictions. For example, the United States, Europe, Australia in particular, all had much higher regulatory risk, certainly coming out of the global financial crisis. Canada almost seemed to have the opposite, which is the sector did very well during the global financial crisis, and it almost seemed to be a validation of the business model, and therefore, if it isn't broke, don't fix it. Interestingly enough, the Australian banks did even better than the Canadian banks during the global financial crisis, but they had a fierce re-regulatory trend. So back to Canada, I think this is fairly new for Canadian bank investors. So it's also new with the current government. So the current government has been enacting several measures that are directly targeting the Canadian banks, whether it's the Dividend Recovery Fund, whether it's special bank taxes. So here we are again with yet another example where it could have some sort of political risk. And then you layer on the straight, very sensible regulatory risk rising, whether it's the stability buffer, increasing capital ratios, which precipitated an equity offering from Bank of Montreal, for example, whether it's stress tests on mortgages, whether it's changing capital rules and higher capital for certain types of mortgages in certain circumstances. Altogether, what it's doing is it's just creating more uncertainty for the Canadian banks. So I think we are now in an environment looking forward where regulatory risk and political risk are starting to mean revert. The Canadian banks are starting to move more towards their global peers.
Okay, so just continuing on, what are the different types of political risk that we could see, additional ones to the ones that you're talking about right now?
Yeah, so not all regulatory risk is created equal. So I would say, whether if it's a special charge, Usually the market doesn't mind so much if, that maybe there's a special bank tax one time, then it just comes out of capital and everybody moves on. But I think there's two types of regulatory risk, I think, that are the most worrisome. The first is anything that relates to capital in size. So, for example, litigation risk can be a big one. You saw CIBC took $1 billion charge. There's large capital destruction. Anything that results in large capital destruction has an impact on future returns. Anti-money laundering. There's been the Financial Times put out an article. Over $30 billion of anti-money laundering charges were taking place in the global banking sector since 2008. And that's a who's who of global banks have taken anti-money laundering charges. This is a very, very big deal because the charges can be extremely large. And the capital destruction that comes from them has a real impact because the affected bank needs a couple of quarters to build capital. They don't invest as much. It negatively affects possibly their multiple in the meantime and their ability to reinvest. That's the first one. So anything that relates to large-scale capital destruction at a one time. The second one is, and this is very, very important, just having to keep more capital. So you're seeing the stability buffer edge up. What you have seen is and so capital levels are quite high for the Canadian banks. They're lower than their global peers, but high in an absolute sense, certainly if you look back 20, 25 years. But what you saw, for example, in Australia is the regulator started to say your minimum capital levels need to go up significantly. It took several years to get to those levels, and the Australian banks over that period of time underperformed. So if the regulator, for example, came forward and said, we think common equity tier 1 ratios really should be not, so maybe right now they're around 12, we think they should be 14, that would precipitate a period of underperformance. We don't think that's going to happen, but that is the worst form of regulatory risk or the most damaging because it can result and translate directly into share price performance. The other one would be maybe anything that has an impact on long-term profitability. For example, a meaningful increase in effective tax rates. Those two, I think, are the ones to worry about the most. And I think what you're seeing right now is this sort of regulatory cloud is joining a macroeconomic cloud, an interest rate cloud, a GDP cloud. And it's just, what happened with, last week with the leader of the opposition coming out and recommending the government reject this acquisition, I think is just further evidence that we are in a new environment where regulatory risk and political risk going forward, Canadian bank investors should assume are higher.
That's great. Very helpful. Like I said earlier, we are active commentators on the sector. We'd encourage everyone to look at our website, hamiltonetfs.com, and visit our insights section. We've written a couple notes recently on the Canadian bank sector that we think you'll find helpful, but we appreciate you listening in and have a good day.